This panel, Corporate Buyers and Investment Banker panel, really another important connector to what we've been talking about today. Our moderator is Bill Kauffman. He's a partner at Oppenheimer, Wolf & Donnelly. Thank you, Bill.
So Kevin, you want to start?
Sure. My name is Kevin Davies. I head the healthcare group at RBC Capital Markets. I've spent the last 16 years in healthcare investment banking.
Hi, Jeff Hoffman. I run our West Coast healthcare effort at JP Morgan, as well as softly run the device effort and been banking for 20 years.
Hi, I'm Sean McCormick, Senior Vice President and CFO of EV3 for about the last 15 months. Prior to that, I was with Medtronic for a little over 16 years with various jobs as senior finance and a lot of business development activities over those years.
Isaac Zacharias. I work at Boston Scientific. I support the newly formed CRV group, which is our CRM and interventional cardiology businesses. Been there about 4 years. So
to kick it off, one of our, we come with paper because we are prepared here. We were going to talk initially about the current environment in M&A and how today's world is affecting decisions by both buyers and sellers, by the bankers that are playing in the area. And I'm just going to throw that open to Kevin to start with, and we'll come down the pike here.
Well, sure. I mean, I think that obviously, M&A has kind of been an underlying theme for a lot of these panels in the last 2 days here. And I think, it's obviously a challenging environment. And I think, the big difference in the last couple of years is this massive volatility we've had in the market, which creates difficulty in getting M&A done. Obviously this audience is, there's a lot of private companies, a lot of VCs where that, the volatility in the public markets obviously affects, trickles down to venture-backed companies as well. But, the environment is getting a little bit better. We've got new volatility now through Europe, which, will be interesting to see how that plays out for the rest of the year. But we had we were very cautiously optimistic as to the reemergence of the M&A market, and obviously as it relates to some public companies, with valuations being down, there's been a meaningful amount of M&A of smaller companies by the typical acquirers in MedTech.
Obviously, I sat on this panel I think last year, and what a year difference makes. Although we're starting to see unrest again in the markets with Europe, but I think the good news is all the capital markets are functioning now very well. So the J&Js, the Abbotts, the Medtronics of the world have very cheap access to capital, and they're earning nothing on their cash. And so they are out there using it to deploy and buy. So they're all looking at things. The question is, it's sort of a tale of two cities in the sense that the top assets that they want to compete for, a Viziogen or an eValve, even though they're pre-FDA approval, got taken out at pretty good numbers, very competitive situations, et cetera. On the flip side is they're also inundated with a lot of early stage companies because of the financing markets and the IPO markets not being open. So what everyone doesn't see is all the deals that are not happening. So I would still describe it for the majority of medtech companies out there as a buyer's market, right? In the sense that it's being driven by the buyer's interest typically. And then the top 5% of assets that are competitive over are still getting really good prices because the discount rates for these buyers is lower. So we still see for the top quality assets a pretty, vibrant M&A market, and the big companies are not earning anything on their cash, so using it to buy R&D projects, et cetera, is a little more frequent than we've seen before. Having said that, they're still passing on a lot of things. So it's really the top quality and a buyer's market. It's hard to drive that process yourself unless you have some interested parties already in this space.
Yeah, I'd say from a buyer's perspective, either today with a mid-cap company or my prior position with Medtronic, the capital markets threw an interesting twist in it over the last year and a half or so. But despite setting that aside, I think the buyers, from a buyer's perspective, getting much more disciplined and much more focused on those top quality assets, as Jeff said. If you go back, several years ago, I think there was just a buying frenzy, and I think all of the buyers, whether it's mid-cap, large cap, are getting much more disciplined about what are truly, differentiating acquisitions, truly getting something novel in terms of the technologies, and paying more for less risk. And I think that's kind of an interesting thing that's going on now with the FDA process is the risk with what FDA approvals are. And buyers are much more interested, I believe, in paying a little bit more for more certainty or for assets that they absolutely and clearly believe are going to be differentiating versus, just taking risks on potential technologies.
The perspective of Boston Scientific in a buying standpoint, we were coming off a binge that culminated with Guidant. In the last 2 to 3 years, we've had a lot of volatility in our markets, our business, and with our senior management. So I think what we're seeing now and the direction we're going, I'd echo what Sean said, we've become much more disciplined in terms of what we're going to look at and what we're going to pay for it. And that's driven by, I think, necessary focus on our core markets and our balance sheet right now. And we've been pretty public about both of those things.
Are you guys seeing any new entrants to the market? I mean, private equity firms, or not to insult anybody, but sort of second-tier med device companies getting more active, looking for deals. You get below sort of J&J and Medtronic and sort of move down. Is there any appreciable thing going on with those type of companies?
Well, I'll address the private equity. Obviously, there's a ton of money in private equity, and as valuations came down the last couple of years, they were very, very interested in medical technology, but not breakthrough medical technology with a lot of risk in clinical trials and reimbursement. They wanted businesses that were sort of low tech, that they could bring some value to, either on the cost side or by driving revenue growth through focus. So you saw them very interested in carve-out transactions, the Convitex of the world, some of the Boston Scientific asset sales that had occurred. They're not typically going to, I don't think they're going to be buyers for most of these venture-backed companies at all, despite having significant amounts of money. They like EBITDA, they're a different buyer, and they typically, they need to have an angle. And their angle will be a management team or a way to reduce costs versus strategics who obviously are trying to drive top-line growth and can synergize most of the expenses below the gross margin line. So there's a fundamentally different sort of reason to buy, and their ability to compete is tougher. They wanted to compete when the valuations, on an EBITDA basis came down from the low teens, mid-teens down to single-digit EBITDA margins, but EBITDA valuations. But those valuations have recovered in some cases.
Covidien, after the spinoff, used to not buy technology and growth, right? Used to buy bottom line plays. They're very much into the active buying phase. CareFusion bought a vertebroplasty company after they've been spun out. So you have some new entrants. Bard just bought Cenerex, and Bard's looking at things we've seen. So I do think you see an active buying pool, which is good. I'd say if you went back 6 to 12 months with the markets being difficult, you had a lot of mid-caps a couple of years ago buying things. You had Cytic out buying a lot. You had Hologic going out. You had the Right Medicals buying things, AMS buying things. And that got hampered when you had the sell-off because these $2 or $3 billion companies were $1 to $2 billion companies and not having access to capital. And now the access to capital is back. So EV3 buys Chestnut Medical, competing against the big guys, and we helped them do that and really kickstarts their growth. So I think you'll see the mid-caps back too. So again, it's a more vibrant, functioning market. I wouldn't say it's a seller's market by any chance, but it's a lot better than it was before. And the convert market's open again for the mid-caps and the debt market. So I'd say the mid-caps are back. The valuations are up. The Volcanoes of the world are buying things. You have a new entrant in ophthalmology, which is Abbott, because AMO was hamstrung by its balance sheet, and now they're active again. And Alcon seems to have its situation done with the Novartis, and they're out actively looking at things. So it's a good market. It's just still being driven by the buyers. It's better, and you do have some new entrants.
You guys have got any advice or comments on, what one can do today in sort of to either drive value or drive the company towards becoming more attractive? Because it's a struggle, I think, that the VCs are out there, and I think they're driving more decisions to sell early. But what can a company do? Can they do anything, or are they sort of stuck if you're not pretty enough?
What adds value is, real strong IP positions, or you're, well along a clinical pathway, a regulatory approval pathway, and or you've established a well-functioning business, not just a product that is to be launched, but you actually have a business that can be rolled in a larger acquirer, can capture cost synergies. I think those are the value drivers. In differentiated technology, I guess it kind of goes along with the IP. But if you've got a venture firm that's trying to make and maybe CTOs is a great example. Everybody's got a CTO technology. Well, none of them that I've seen are truly breakthrough. And so if you're going to do a CTO acquisition, well, it's just one of a bunch that work in a niche, but none of them are truly breakthrough. Well, that, I believe, you're going to struggle to exit a company like that unless you've got some good IP, you've already got your regulatory approval, or you've got a decent operation that can be pulled in. But otherwise, it's just a Me Too product for the sake of some revenue. Those, in my perspective, for a mid-cap, those aren't very attractive. That's not how we're going to add value to our shareholders.
Bill, the advice we try to give companies is be more judicious with your cash, right, and be more focused, because you need to get things further along if it's a buyer's market and you're not going to be able to push it at your time frame. But also, we really advise companies to be upfront and educating the buyer universe on your development path, because you never do know when one of those guys is going to step forward. And we think the majority, again, of those companies are being bought and someone gets interested. And you just don't know when someone's getting interested if you're literally doing everything by yourself in stealth and no one's aware of what you're doing. I mean, at the conferences, you don't have to give away the secret sauce or the proprietariness, but you should be meeting with, Isaac at Boston. You should be meeting with Chad Cornell at Medtronic. You should be meeting with Susan Marino at J&J, or the corporate counterparts in your areas, and educating them what you're doing, because you never know where that hole is, and if someone wants to step up early. A lot of people didn't want to step up and buy eValve early, but Abbott did because they wanted to have that play. And so I think you need to educate and let these people know what's going on, and they're inundated right now, so it's hard for them to just get out and find you.
The hardest thing when I go in and pitch to our CFO and our CEO is, they're looking at an environment where their operating margins are going to get pressured over the next 5 years, and there's no belief that operating margins are going to get better. So when we look at stuff and we're talking to them, they need to see, and the volatility that they see right now in the regulatory environments and in the political environment scares them, or scare is probably the wrong word, but makes them cautious. And so with that as the context, the best thing I can tell them is this company has reduced risk in this way. And you don't have to be sexy to reduce risk, but that's an easy sell. If I can go to them and say, here's what you're worried about, here's what we are historically worried about, and here's what they've done about it. And that doesn't necessarily mean you have to be all the way through that process, but you got to be further along now than it was, because early is now late. Or today's early, I guess, is yesterday's late.
Or it's a function of price and stage, right? I mean, if you get your valuations too far ahead of you, you're not going to be able to do it earlier. Like Light Lab got today at $70 million for St. Jude. I mean, it's eValve, he's right, was a lot further along on the clinical data side, but still, with this FDA, $400 million down is a big bet what the FDA is going to do. So like I said, I think you got to adjust it for price, but if you get ahead of yourselves in value, it's going to be even harder for those guys, because they risk adjust the asset when they're trying to buy it. And Sean said it earlier, I think it's true, when you talk to Abbott and others, they'd much rather pay a much bigger price for a de-risked asset. I mean, I don't think Abbott would have wanted to buy Viziogen until it was approved, but they couldn't afford to have one of the other buyers in the space have it, and the other buyer couldn't afford, because there was nothing for 4 or 5 years behind it. So those are the kind of things you have to consider as you're going through.
Well, I think to the point of potentially going to the strategics a little earlier. I mean, one of the other panelists had mentioned, to the extent the FDA is so difficult, you may get a price that's very much dependent upon the quality of the clinical data, and the extent that you want, really Medtronic is the right one to put the amount of money and the design around a clinical trial to actually get the product approved. You have to go earlier, pre-IDE, to really even see, whether the acquirers are going to be interested based on your clinical trial that you're thinking about running in the U.S., your PMA trial. I think that's led to this, this trend of CE mark in Europe, initial launch, getting clinical data, not even filing for a PMA trial in the U.S. and trying to sell the company so that the large acquirer can actually design that trial and take the product through in the U.S.
And do you think that the large consolidators have any advantage in getting something through with the FDA over the small companies, or is it just, a complete random, pot shot?
My view is historically they actually probably had a little bit of a disadvantage, but it really is company by company. And I think, when you're in the company, you feel like the FDA is against you and they're for somebody else. It's a little bit the history. I think it's all changing, though. I think the focus today is even the smaller companies, and we saw it recently here with Atratech, that the FDA is getting conservative and they're changing the game, and I don't know that anybody has an advantage anymore. Maybe the advantage is in, you've got the experience and a good relationship, and so maybe there's a level of trust that might become an advantage. But overall, I think things are changing to the point that everybody needs to expect. You need to have your protocols, your data, your processes very, very buttoned up, or you should expect the unexpected from the FDA.
That's the problem with trying to sell early and have a big company buy you, because they're going to assume. I remember when we sold EVT to Guidant way back when, but the burn went from 15 million to 40, the way they wanted to spend to get the finish through. So with allocations of overhead and those things, that makes it hard.
We look at it as we're either going to pay, we're going to pay somewhere. And it cost us, we will do things more expensively than a small venture-backed company will, and we should do things more expensively than a small venture-backed company will. So we'll either buy it and pay later, or pay as we go, or we'll buy it late and pay to redo it.
Yeah, I think you got to assume you're going to be an independent company and run it that way, and you got to be judicious with your cash, and you got to educate people along the way, because you don't know if someone's going to want to buy you early or late. It depends on the buyer's appetite in this market. And if the IPO market came back to an earlier stage, it gives you other opportunities or other access to capital. But you got to run the business to be independent, and you got to educate people, and you got to be much more cautious in today's environment what you spend.
When you're in that situation where the company is thinking about selling, or at least wants to start the process, how soon to get a hold of you guys?
The earlier the better. A process will maximize value, but it's also good to talk to the bankers about whether it even makes sense to conduct a process and whether you're too early to go. So early on in a process, I think bankers, they want to earn your trust. They want to give you good advice. So the reality is, take the temperature of what they think, because they're talking to all the buyers all the time as to whether you should be even conducting a process at this point or waiting. And that informs the board, obviously, about financing, and do we do a next round, do we do a bridge round? So the earlier the better.
I mean, the simple answer is we're free until there's a transaction, so you might as well use us. And one, we want to get to know folks early, and we'll give you straightforward advice. I often tell companies who want to proactively sell in this market, it's not the right time. And sometimes they take that advice and wait, and they still educate and wait for. When we sold ablation to Medtronic, what Sean did when he was at Medtronic, they had already basically had an oral offer, and then they engaged us to run a process. But we had been behind the scenes talking to the management and educating them all the way through. But we told them not to formally launch anything until there was real interest. And so I think, like Kevin said, the earlier the better, and we'll give you that advice as you think through it.
As difficult as bankers are to deal with and stomach, it's harder. It's actually harder to execute a transaction with a management team that doesn't have the experience without a banker involved. And so having that expertise and that experience, to support you if you're actually into a transaction that is to the benefit of a seller, but it actually is easier for a buyer as well.
What's your day like? I mean, are you and what motivates you to take a meeting, and what sort of motivates you to sort of say, I'm too busy, or I'm not interested? I mean, how do these companies out there, get a meeting with the BSC?
Our job, my job, my group's job is to talk to people and figure out what's out there, and then filter that up to, our business unit leaders. And we look for direction from the business on what they want their strategy to be and where they want us to focus. And so sometimes, things are just out of that focus. We politely decline, but we do meetings. That's our day to day.
And you're not too worried about it being too early. If you want to find out. Jeff was saying.
Some meetings are quicker than others, but.
Yeah. Let's talk a second about a topic that's sort of near and dear to a lot of VCs' hearts and company people, and that's earnouts and what's going on in the market with respect to structuring deals, and whether people are seeing more earnouts, whether we're seeing more sharing of the risk and willingness, and I know you guys have got some opinions about that.
With private companies, they're on the rise. They're a way to bridge the valuation gap between buyers and sellers when markets are unstable and when there's considerable risk. So I think we'll continue to see earnouts be an important part of transactions. I think buyers are very sophisticated with the venture community now. Meet with them regularly. It's interesting that the buyers are asking for cap tables and understanding preferences, in transactions. So I think they're very much in tune with kind of what's going on with the venture world, obviously, and will want to take advantage of that to the extent that they can. So it's going to continue to rise. I would expect anyway.
Yeah, there's a lot of constituents to think about the earnouts, because historically, when it's been a seller's market, the venture community or the boards or others is using a high discount rate on any earnout wouldn't want it, right? And if you had a lot of seller power, you would push towards not having an earnout, and most people didn't like them because they could be lawsuits waiting to happen, so they need to be structured well. Secondly, buyers liked them because it was a risk allocation of capital, and they would be risk sharing if they could get it, and also they used to get some good accounting treatment, which has gone away. So now the accounting's become pretty onerous for the buyers, and actually if you talk to Abbott or others, and we had to deal with it on Chestnut because we use an earnout, you have to each quarter sort of recalibrate the asset and the earnout and take current charges. There's not the accounting benefit. So all things being equal, they don't like earnouts. On the flip side is they like the earnouts from a risk and a capital standpoint. So the buyers go back and forth on it. So we sold Visiogen and eValve literally within a week of each other, and eValve had an earnout and Visiogen went away, started as an earnout, went away from it because they didn't want the accounting treatment and deal with it. So there's a lot of constituents you need to deal with, but I think in this market, as Kevin said, it's going to increase because people are trying to go earlier. And with the FDA risk being high, people are structuring a lot of value around these, and I think the venture community is more apt to take them now because liquidity events are fewer and they're important, so there is an appetite to risk share, where in the past there hasn't. So it's clearly on the upswing, but there is some negative forces against it, which is the accounting change.
Yeah, from the CFO chair, the accounting implications of it, I think we were literally one of the first companies to do an acquisition under the new accounting rules with earnouts, and I believe one of the challenges is, or the risk is having the analyst community truly understand these accounting rules yet, and it's just that it's so new, and we haven't seen earnout type transactions flushing through. I have the potential with the Chestnut acquisition, I could have negative news which would actually create income on my P&L because of the way you account for an earnout. The flip side of that is if you have very positive news, you can have a big one-time non-cash charge to your P&L. And so it's very complicated, and it's going to take time to help the analyst community understand these pluses and minuses. We actually, when we did the Chestnut acquisition, because of our NOL position, we recorded $19 million of income on the tax line, which, so we should do acquisitions all the time, just keep recording income. But, it's just the accounting is very complex, and it is going to be it's going to take some time, I believe, for us as public companies to help the analyst community understand and back out these one-time, funny accounting charges as they occur, whether they're the expenses or the income that can be triggered. And so it is a risk, and it is a big consideration. I would much rather, in my CFO role, I'd much rather have an all-in, clean deal and not have to deal with the accounting implications. But as Jeff said, that means we value it appropriately for the risk, which for the venture community, you're basically saying, well, I don't want to sell at that cheaper price. You'd rather have something extra in the game, if the technology proves out, and that becomes the kind of the rub in closing the gap.
It should be efficient, right, if the NPV is the same, but the clear problem is the discount rates that someone's using could be different. And then the other thing is to be honest, a lot of venture community wants multiples of money as opposed to IRR. So again, waiting an extra year or two for an earnout to pay, if it's a much bigger number on an absolute basis, actually has more appeal, and it has less appeal to a buyer who would want to pay an NPV significantly lower. So there is that situation too to balance.
Right. Well, practically, what we look for when we're doing deals now, or proposing deals, is to structure the earnouts so that they're discrete. BSC had a number of deals over the years that looked like revenue multiple earnouts, and in this environment with the accounting, the unpredictability of those is almost impossible to appropriately account for. So we're moving towards structures that look like discrete earnouts, whether PMA approval, a sales number, as opposed to a multiple of sales over time, and that's practically how we're trying to deal with the accounting changes.
I mean, a lot of the revenue multiple things that you guys came up with in the past actually worked pretty well, except for the accounting, because people were aligned, right? So you didn't have people, if you're paying 1.5 times revenue and trading it 4 times, the more you sell, the better.
Absolutely.
And then you didn't have a seller sitting here saying the buyer's not motivated to do it. You have a cliff.
They said it anyway, don't worry.
Yeah, of course.
Yeah.
But you had a lot less lawsuits when you went to the structure that Boston, frankly, started with the growth revenue earnout than you did before. And that's why people went away from earnouts, because historically, even before that, with the good accounting, the discrete ones often ended up lawsuits. Now we're sort of going back. When you hear the buyers say they want discrete, and you have people willing to do it, it is inevitable you're going to have some lawsuits going forward. And that's a risk factor. It's another reason why people don't like the earnout structure.
What we say, and we mean this, we love paying earnouts. When we structure a deal with earnouts, if we pay that earnout, and I think you're going to feel this way about Chestnut, you're going to be happy to pay the 150 or the 75 on Chestnut, because that means you got that product on the market in 11.
We're absolutely happy to pay out earnouts if they're structured appropriately. We've got some of the old acquisitions at EV3 before I was there, a structure that absolutely makes no sense to me, but I hear it come from the bankers a lot, is if you cross a certain revenue threshold, then we should get 1 times or 2 times or 3 times that additional revenue. Well, talk about a disincentive to cross a revenue threshold where you're going to pay out 2 or 3 times the incremental revenue you're achieving. That type of earnout makes no sense. What we have with Chestnut, though, is you get approval of the device so that we can market it and commercialize it. We absolutely want to pay that earnout, and because we believe the market will absolutely justify that payment. So.
When we were talking last week in preparation, we talked a little bit about what are the places that people are looking to make acquisitions, where's the white space, what sort of new and distinctive technology, and we thought we might try to circle back a little bit and talk about from an M&A perspective, some of the things that you heard yesterday on those 4 submarkets and any other places that these guys think are hot places to be. So you want to jump in?
At EV3, we're not in a position where we're looking for white space, and we think the reason the Chestnut acquisition works so well, and we're being rewarded for it, and this is what I was talking to a little bit earlier, is we acquired a technology that in a space that we understand the space very intimately. And so we got very comfortable with our knowledge of the market, with our connections with physicians, with our understanding of the various technologies, that was something that absolutely was going to be a game changer. And that's the type of thing we're looking for within our current businesses, our neurovascular business and our peripheral vascular business. So I look at it much more from a disruptive technology standpoint, an ability for us to leverage our knowledge and our expertise, in our markets, to add value and to truly understand, what is going to make a difference versus what would just add growth. And our strategy isn't to just add growth. We want to make a difference, because we have limited capital, with which to do business development. And we're not looking for that white space diversification that the larger guys might be. So.
I'd say the device approach to the blood pressure problem, the Ardians of the world, the CVRXs of the world, is very interesting to the buyers because they're drug-sized markets with, different techniques to go after it. New white space, respiratory, asthmatics approval changes things. There are people who've been waiting for new respiratory, interventional type products. Neuro is a hot topic right now. And then obesity, but I think people are staying away from the stimulation side of obesity just because of the failures in that market. So that's, again, you have an FDA and you have a risk, but obesity is an interesting area from a minimally invasive treatment. There's people looking at it. So, and again, obviously diabetes is always huge, but I think from a strip testing standpoint, that's become a little more commoditized and less growth, but and it's a longer cycle for the Dexcoms and the continuous sensing, but still diabetes is a huge opportunity that people are still looking at from a patch pump or a pump standpoint.
Yeah, I mean, I think, the 4 panels that were yesterday, that happened yesterday, the only one that hasn't seen, consolidation as a white space area yet is obesity, and it goes back to the point of all the risks that are still inherent in really what is the path to a breakthrough product and what is obviously an enormous market opportunity there. But each of the other 3 sectors, women's health, ophthalmology, and what was the other? ENT. Obviously have had significant transactions in the last year. And what's interesting about each of those 3 tracks were there were assets of size. And so white space kind of means different things to different people. Clarence is a big asset in ENT, which has not been a traditionally big space for all the device companies to go after, but a breakthrough technology with scale represented white space to a big acquirer. So I think it means kind of different things to different people. And once we get over the clinical hurdles, if we ever do on the obesity side, there's hundreds of companies that potentially could grow out of that one space. And I think someone had mentioned 35 companies working in the space, which is a very large number, obviously. So
I mean, J&J is now in aesthetics with Mentor and things, and Couloir and others that they hadn't been in before. So you have a new entrant there. J&J is in ENT now with Smith & Nephew and Medtronic being the largest in ENT. And then ophthalmology is definitely an area. Your panel with Abbott being into it, and we've seen Allergan actually look back at novel devices, not necessarily going straight into the surgical space, but looking at surgical products that deal with the consumer and some of their strengths. So you have new areas being more interesting to folks. Again, I mean, there's a lot of activity in the ophthalmology space right now.
Well, I wanted to just touch a little bit about sort of due diligence issues as it relates to the acquisitions. And we touched upon earlier, what's going on with the FDA. And the other one that, people sometimes talk about is sort of rising up in the level of concern is business practices and, sales and marketing activities. And I was just looking for some reactions from the panel on advice you might be giving people in the audience about sort of having, I guess FDA, I don't know what you can say other than, cross your fingers. But in terms of the business practices, sales and marketing and things that you've seen that might have caused problems or companies that have done a good job of being ready for that acquisition.
We don't oftentimes deal with sales practices, but the healthcare provider rules that are being put in place are onerous. And so even if you don't have sales, we spend a lot of time right now looking at how clinical trial arrangements are set up, how equity arrangements are set up with investigators and SABs and board members, and those can be problematic. So I would encourage folks to, even wait pre-sales. There are healthcare provider issues that we have or will have in today's environment that you should be conscious of as you're setting up agreements with investigators and physicians, consultants.
Whether you're pre-revenue or not, you need to be sensitive to what revenue-generating public companies are sensitive to today. I mean, we're very sensitive to healthcare provider relationships, very sensitive to FCPA, very sensitive, to business conduct standards. And because of those sensitivities, those are things that we would focus on in a diligence process, and we don't want to look at acquiring potential risks in that regard. And one of the risks of an integration is if you have a culture that is a little bit looser in having relationships that at a revenue stage you're not going to be able to have, that raises questions about, well, what's going to happen when that's changed or cleaned up, in quotation marks, not saying that it's completely inappropriate. But you need to be sensitive to what the sensitivities are for the potential acquiring companies, and those are things that we're going to dive into and do risk assessments on.
It's a lot harder now. It used to be FDA and is the clinical data as a product getting approved. Well, now when we sold Surgerex to J&J, they looked at the sales practices, and the company was worried about making a rep and warranty because they gave golf balls out to a client at a golf tournament, right? I mean, and J&J was worried about that. And when J&J bought a Clarent, we sold a Clarent, they shut down the off-label product, which Clarent management will tell you they felt completely comfortable selling, et cetera. And I know when another buyer looked at it, they were going to shut that product down and didn't want to value it until it was actually approved. So off-label, huge issue for folks right now. I mean, you saw St. Jude in the press the other day for it on the ablation side. I think it drove a lot of Medtronic's desire to buy the 2 assets they bought to get on-label products. So off-label sales practices is critical. You can't, and the doctor relations that you guys hit is critical. And then obviously, if you're talking about pre-FDA approval, the clinical trial design and the robust data is critical.
From a buyer's standpoint, reducing risk and understanding kind of where the risks are. If you're setting up your company and spending your capital wisely, you should be doing things with an eye towards on-label, approved indications. And, the biliary path for SFA stents, for instance, is no longer available. The DOJ is in every large cap right now with multiple investigations on different marketing practices. We can't value stuff that is where money has been spent and things could be sold, from a regulatory standpoint. But if we can't market it on label, we can't value it. You can demonstrate physician reimbursement, but I think the value is from a revenue standpoint, and being able to drive that revenue is very limited.
I mean, at one point in time in history, it was all about the revenue ramp. That's just not the case anymore. I'd rather see in the Chestnut acquisition, I keep referring back to it, they had not gone commercial internationally for all practical purposes, but they were doing the clinical right, which is what we were very concerned about. That was much more important to us than having them have shown a revenue ramp. We knew the market, we knew the potential. We can build our own models of how the revenue is going to ramp, and then and have faith in our ability to execute to it. We didn't need to see them doing that to be interested in the technology. But had we seen a revenue ramp, it could have been completely mitigated and maybe even turned into a negative if they had done it through what we would have determined to be inappropriate practices.
People that I talk to and work with, discuss whether they should go to Europe and start selling in Europe. You're getting the CE mark early. Is it worth it? Is it not worth it? It sounds like that's really open for debate in terms of whether you really get much bang.
It's company specific. I mean, if you're selling it right and it's good reimbursement and it's mitigating your burn, it's probably worth it, right? But like Sean was saying, you could just go to a couple small areas and make sure you're getting the test out in the market and understanding how the product works and getting that clinical data back, because again, a large buyer is going to have its own distribution network and can extrapolate that. But look, if you can get significant revenue in Europe and do it right and learn about the product in an appropriate business manner, St. Francis mitigated its burn significantly and didn't have to finance because they were getting 20. Ablation was selling really nice in Europe too. So there's good reasons to do it, but it's company specific and it's a cost assessment too, because it can be either costly or you might want to do it Viziogen was doing it very limited to get some experience with it, where Ionics went broad and it backfired because they had bad clinical experience, so they fixed it. So it really is company specific. I think you got to make the right business decision on it and do your IRR calculation internally as a return on investment.
If you're going out for revenue internationally just for the sake of showing revenue, that's not the right approach. If you're looking at building an ongoing sustainable business and assuming you're going to be independent long term, and the right decision is to go out and build revenue, then you're going to do it for the long term. Then it makes, with IRRs, and if it offsets your burn, that's the right approach. To go out and say, hey, we think we can go out and build some revenue ramp and it'll make us more attractive, that's not the right criteria.
During our conversations earlier, we talked about the idea of the investment by the by the consolidator, or investment by the ultimate buyer in the company along the way, kind of a step transaction. And I know a lot of companies sort of fear that because of it'll shorten up their options. Others have successfully done it. Do you guys got any comments on that? Getting the guys in for the D round or the C round prior to the possibly exit transaction?
I mean, in this environment, strategic money is good because it's money and it funds the company. And it just comes down to, what are the rights, what are the territories that you're giving up in terms of potentially a sales partner, and also, does it tie your hands at all for an ultimate acquisition to that party, or do you have the rights to go out and sell to whoever the highest bidder is at the time that you decide to sell the company? So I think, certainly, VC-backed companies are more receptive to that now just because it's a source of capital, and capital is scarce.
I mean, look, if you get a CVRX or Interpulse type with just straight up investments at good valuations that aren't dilutive, with no real rights, and you get good partners that help you develop stuff, those are great. If you get Cameron Health, for example, that looked like an amazing deal when it got done because it was so much money, but it ended up taking a lot longer and a lot more money, and you were stuck under an option agreement that was very challenging to raise money again in. So if you do an option investment with an option that really ties you up, you need to really make sure you're getting enough capital. And you almost always see people underestimate how much capital you get. So you need to either get free from the option before your capital runs out, or have enough capital to figure out if the option is going to get exercised or not.
I think we're finished. It's we're right on time. Some of the guys will be around afterwards. I know that there's a couple calls that have to be, but they may circulate after the 3 o'clock session too. So feel free to buttonhole them. They'll give you some money if you really need it.